got quiet.
The 16th and traffic way I noticed.
I'd like to welcome everybody that's here with us and those that are viewing online. We're going to be delayed just a couple minutes. We're waiting for our board chair to get in so the meeting can start. It should be any moment. I think there's a little traffic congestion due to rodeo traffic. But I think this is a presentation our board will appreciate. It'll be a learning opportunity for all of us. This will be about the third time that I've heard something of this type of a presentation. And I think there's been some improvement in the numbers as we move. So I think this is going to be an exciting time for our district, our union, for our employees, our school board moving forward. Good afternoon, Ms. Mott.
My apologies. Rodeo traffic. I don't know what else to tell you between here and the college. What normally takes 5 minutes, it's taking. Oh, my goodness.
That's the only one, yeah.
Good afternoon. It is 5:01 p.m. We will call this workshop to order. Today is Thursday, March the 9th. We are going to dispense with the pledge and the prayer for purposes of roll call. All members except for Mrs. Chancey are here. And we'll begin with our health insurance workshop, which is the topic of discussion today. Dr. Bennett.
Yes, ma'am. At this time, Darren, I'm going to let you introduce all of the players to the audience here and at home. If you wouldn't, if you'll speak into that laptop.
Just
Or
speak
this-
loud, it can pick you up if you will, so.
Okay.
As long as you talk loud, it'd be good.
Madam Chair, members of the board, Dr. Bennett, thank you for letting us be here today to present our program that, like Dr. Bennett said, we've gone through your insurance committee. And so we're now here to talk to you guys about what it is that we're so excited about. I'm Darren Bryan. I am a consultant for the board with Avail Benefits. These guys with me, I have Nicole Leal, who works with me at Avail, and Jim Powell and Joe Logan are with Alliant and Insurance Services. They're with FSHIP or FSBIT, the actual housing of the program. So they're going to get into the numbers today a little bit so you can see kind of the financial side of this. I'm going to be helping you all to understand what they're talking about. So as your consultant to the board, I've gone through these workshops or insurance committee meetings for 10 years, kind of getting everybody ready to understand this. We've had 2 with the insurance committee so far. So we're going to try to catch you up on the difference between self-funding and fully insured and what some of these terms mean. I think we have a little bit of time, right? Because I even put in honor of South Florida State College of Insurance 101. So in part of this, so we'll jump in. Anytime you guys have any questions, please stop me and Jim or Joe, because we know that it's kind of a different thing. If you're used to fully insured insurance, which that's what we have today, moving to self-funding can be somewhat confusing. If you have no clue what I said on both of them, then that's kind of good. So because we're going to kind of teach you a little bit about that. The big part about what we're talking about is, let me sum it up really quick, is we're trying to build a program that has no impact to employees, as in the type of insurance they have, as in the carrier they use, which is Florida Blue. We're not talking about changing the benefit plan. We're not talking about changing doctors, pharmacy, any of that. So really what we're talking about is how the board will finance the health insurance. So we'll jump into that really quick. Uh-oh, Marcus.
Might just need to click.
So I got it, yeah. So I'm gonna go over how we arrived here today. We're going to introduce some goals to talk about, better understand how we'll potentially save money on our health insurance costs. That is our biggest spend and employee benefits on the health insurance side, of course. Key terms, we're going to talk about the current project for all of our Avail clients. DeSoto Schools is an Avail client. So we are going to talk about that and then the actual FSHIP Alliant Avail risk sharing program. So how we arrived here, a couple years ago, the insurance committee, I shouldn't say a couple years ago, probably almost every year that when I was your agent, there was always being asked from the insurance committee, can't we as school systems pull together somehow? The state has their insurance together in some things. There's agencies that really work for the state. Why can't school boards do that? And there's several reasons why. So we, a couple years ago, my partner and I dug into why is it? What are the biggest problems or the biggest hurdles we see? And they're unique to school boards, and it's really about benefit independence. And when I say that, there is statute out there that allows consortiums to join together. And you might have even heard of PACE is one. We have the Heartland Education Consortium that you guys are a member of. NEFAC is another one, and that is an example of an health insurance program that's no longer in existence. It died a few years back. PACE is one that's still doing it. It's a little bit different than what we're presenting. It's different because statute kind of says consortiums have rules to follow, and there is a head district in the consortium that kind of becomes, in Highlands County is, for example, the lead of the Heartland Education Consortium. And so if we were to try to risk share with them, we would have to really join their program. And so that really doesn't work well with school boards. School boards want their independence. The unions, collective bargaining, they want their independence. They want their employees to have the choice of what it is, the plan design, the insurance carrier. That can become a problem with rural school districts because some insurance carriers don't have the same network interiorly as they do on the outside of Florida in the more urban areas. So collective bargaining was one that we had to overcome that hurdle, plan design, and then carrier selection. So it really, benefit independence was a big reason, or is the reason, you're not seeing a lot of true risk sharing in school boards today. So we began to work on how can we do this? How can we overcome those hurdles? We dug through regulatory and legal questions, and we built this program along with Alliant FSHIP, and we're here now ready to unveil it. A couple years ago, I gave a presentation, I guess it's been about a year and a half, to the superintendents at HEC, and said, look, we're 12 to 18 months out, but we think we've got this solved. Let's jump into this and let's see if we can begin building it. And we're here tonight at really the end result a little bit. We're almost there. And so we're excited to present you what we've come across and whether or not the board is interested in moving forward. And so the Fitbit FSHIP solution is what we have. So the goal of our program, of course, is cost saving opportunities, individual district benefit customization, lowering of long-term claims volatility. You'll hear that today from Jim and Joe about smoothing. There's been times where we being the DeSoto County School District, when it comes to insurance rates or the premium that this district is paid has been flat, whereas there isn't a renewal increase, and then there's been threatenings of 20% increase, and that's tough on budgeting, right? And so one of the things that a big goal of this program, and you'll hear Joe talk about a little bit more, is the smoothing effect that self-funding can give, mainly because you begin paying your claims, but I'll let Joe get into the goodies of that. Risk sharing among districts. So that is the end goal of this program. This is where the rubber hits the road and how this one is different, because this program is built so that any district that comes in eventually will earn the opportunity to risk share with other districts. And when I say that, earn the opportunity, what does that mean? That means the first couple of years, at least 1 year, maybe 2, the DeSoto School District will be self-funded on its own. It's not going to be risk sharing with any other district. So when you join, if you were to join the FSHIP program, you're really going to be taking advantage of some of the FSHIP opportunities, which comes with the pharmacy program. They'll talk about that, about how you can save money in there. But we're going to be standing on our own when it comes to our claims and how we perform for at least 1 year. There's going to be an application to the risk sharing piece that FSHIP says, look, okay, DeSoto, if you meet these criteria, we're going to let you there's a potential for you to share in some of your risk in what we call claims banding. I'll show you that with other school districts. And that's really the biggest difference that this program is compared to other consortium type sharing program. This is really a different piece than PACE, for example.
For clarification, though, we're not talking about risk sharing in terms of what we would be in for at least the next year or two.
Yes, sir.
We'd have a reinsurance piece on some of that risk, correct?
All of it, except for the part that you hold, and we'll show you that.
Okay.
Yeah, but the reason why I bring it up is because that is the goal. That is the differentiator between this program. So the FSHIP is starting off as a risk sharing program. It's just that members have to kind of earn their way in. And so since we're jumping in, well, if DeSoto goes forward, we would be entering as a kind of our first year, kind of a probationary type of scenario where are we earning that criteria so that we can risk share in the future. But this is a risk sharing program. A potential ROI or return on investment dividend. So the risk sharing would allow potentially for different districts to put money in. And I'm not trying to confuse you, but I really want you to understand that this is part of the eventual goal of this program, is that districts put money into a pot. Claims are paid out of that pot in that sharing layer. And then if there's money left over, you can either get it back or it can be reinvested. Those are the things that Joe will talk about a little bit too. Established preferred networks, this is a unique piece. And so I've already kind of hinted to Dr. Bennett a little bit about this is something that local doctors and our local hospital here for years has tried to build types of connections or any type of coalitions together with the district for years. And because we were fully insured with Florida Blue, it made no sense really financially for us to do that. And that's because we were already paying Florida Blue to transfer all of our healthcare risk to them. And so it would cost us more money to try to establish some kind of special project or some kind of special network with the local hospital. If we become self-funded, then that becomes a big possibility. And so where it could really help us. So that's kind of a cool thing that this could bring. And that's maximizing your local healthcare delivery system. So year one here, possibly two as well. We don't know yet. We're still building that piece.
Darren,
Yes.
again, and I don't want to slow you down. but I just
Please,
make sure
every time.
clarification. If we're going to maximize the local hospital, we're going to try to do that. That would involve a meeting
Yes, sir.
or several meetings, a series of meetings to get discount pricing, et cetera,
That's right.
for employees. But those employees that live in Sarasota or Fort Myers still have the Florida Blue network access. Am I correct in that?
Yeah, 100%. Yes, sir. Yes, sir. That is the plan. And I have, I've even gotten written confirmation from Florida Blue that we're good to move forward.
So they're on board with it.
If they're at this point in time, and he said, we are fine for the district ASO with us. So that we'll get into what that means in a little bit. Yeah. So that was important for me to get Florida Blue to say that. So it's a big deal, but that's a part of the uniqueness of this program, because for example, in the other consortium where they do some risk sharing, there's one that you choose the school district of the lead school district, whatever they choose is what everyone else has to use in the interlocal agreements. For example, Charlotte is a member of FSHIP right now, Charlotte Schools, and they're with United Healthcare. So if you were to join FSHIP with Florida Blue saying that's two different carriers. So that's very unique in this program. You don't see that. I don't know that's happening in any other risk sharing or any type of pooling program in the state of Florida. So if it is, I don't know where it is. So basic terms for today's discussion. Risk, chance of something unwanted happening. We get that, right? That is really what we're talking about today on the health side. That's important because lowering that risk is really what we're trying to do. And that is a big piece of being able to get into the risk sharing is what are we doing? What will we be doing as a district to control our risk on the health side? Risk transfer is the contractual shifting of a pure risk from one party to another. We have been doing a pure, true risk transfer to Florida Blue, and that we were fully insured and we would pay a premium each month. And that premium would go to Florida Blue, and they would then they would pay all those claims, and they also made a profit, right? Because we were transferring all of our risks to them. And so that's important piece, because now we're going to do some risk retention. We're going to hold that risk. So an individual or an organization decision to take financial responsibility for a particular risk it faces. Self-funding, we're going to hold some of our risk, not all of it. It's not true self-funding. We are going to risk transfer, and that's what Alliance team comes in with FSHIP. That's why we need FSHIP. We're going to transfer a lot of those high cost claims over that way. Actually, we're going to transfer more than we are today. That's pretty neat. And we're going to save some money in doing that. Risk financing, financing strategy used by businesses that involves figuring out how to cover risks in the most cost-effective way. That's truly what we're doing in this decision, is how are we going to finance our risk? Our risk is here. We're not going to get rid of it. We can transfer it, and we can figure out how to pay for it. And that's what we're talking about today, of our health risk. Risk sharing is when we share that risk with other parties. And I just wanted you to know about that from the FSHIP perspective, because it is a built-in fundamental piece of that program. It's just that year one for sure, we are not risk sharing. We are staying on our own. We are sharing in some of the purchasing power of FSHIP. For example, Jim and Joe will talk about CoreTrust, their pharmacy program, and how much how that is affecting our projected costs. So we're sharing in that, but that's just sharing in the opportunity to be a client, or to be a client of that pharmacy program. So fully funded or fully insured, the risk transfers over to an insurance carrier. That's what we are in today. That is our contract with Florida Blue today. This is what our contract with Florida Blue will be next year. When I say next year, October 1st, unless we decide to change and go self-funded. Okay. Self-funded, the risk stays with the employer, for lack of better terms. Claims banding are the tiered structure. We use a 3-tier structure to describe that. I've got some illustrations to show you that today. And that where we envision the risk sharing to take place. And I'll also show you that won't be year one. Year one will be the part we hold, and then the part we transfer. So a little bit of insurance 101, fully funded. So this is a fully funded silo, right? So this is the type of insurance that we have today. So the risk transfer piece at the bottom, we start with a risk transfer, and that doesn't work very good. The very bottom, can everyone see that? I guess you can see on both, right? Is the deductible that the employee has. So the out-of-pocket maximum thing about an employee has, we have a portion of our benefit structure that the employee has to pay the deductible first, right? So we're transferring, as a district, we're transferring that burden, or risk, I should say, onto the employee to cover first. Okay, and so we use that as an employee deductible. The second layer of risk transfer is when we pay a premium, the district pays a premium to Florida Blue to take that risk, and we call that a monthly premium. And then the risk change is the renewal rate. So if our risk goes up, as in we have a lot of high cost claims, Florida Blue says, hey, you know what? Your risk has changed. It's gotten worse. We're going to charge you more. Or, hey, your risk has gotten better. We're going to be able to give you a rate decrease, which we don't see those ever. I mean, that's almost, I don't even know, you can be stoned if you say that in some places. But depending on where you're at. So this is an example of our risk financing strategy and the cost of that strategy. That's fully insured. I mean, really, that is 101. That is simple, but that really is how it works. So from a annual premium perspective, that is self or fully insured funding. And that is what we're doing today. We're doing that with all of our products, all of our health to our ancillary dental vision, everything is fully insured. Any questions so far on that? So self-funding basics, almost exactly the same thing, except for that layer where we retain it. So again, we're transferring risk to the employees in that they have a deductible or out-of-pocket maximum they have to meet. That's at the bottom layer. Our risk retention, though, remember that used to say risk transfer on the fully funded. On the self-funded, that says risk retention, and that is where we pay claims. Like we pay them directly. We'll pay them to FSBIT. So FSBIT will give us a funding number. Hey, you guys own this, and then FSBIT will pay those claims to Florida Blue. We will transfer some risk, even in because we're not going to hold all of it through the catastrophic stuff. And Joe will talk a little bit about called an ISL or individual stop loss and an aggregate stop loss to protect the district from major catastrophe. So stop loss premium is what these guys will talk about today, and we'll show you how that's built into a premium. Risk change, again, same thing, is if our risk gets better, right, then that is the cost, right? So that is our premium or funding adjustment. So if our risk goes up because we have a bad year, these guys come in, they say, hey, looks like we're predicting a pretty bad year next year because we still got some claims that are ongoing. We need to change our funding level. You need to put more in your fund, in your kitty. So you're not paying premium anymore. You're just putting money into your savings account to pay your claims. Kind of like that. Think of it that way. Your risk financing strategy is your cost of your strategy. So it's the same thing, except as in the same example, one's self-funded, one's fully insured, one you're holding the risk, think of that, and the other one you're transferring in Florida. Claims banding, really quick. We called it, do not use these numbers. These numbers are there just for illustrative purposes. Those are not ours. If those were what Joe and Jim will be presenting tonight, would be 0 to 125,000, not 50. Which with Florida Blue right now, that number is 240,000, but with these guys, it goes down that much, and we'll talk about why that is. But those, we call that that attritional band. The second band is the marginal claims. We will not have this band this first year. When risk sharing occurs, this will be the band that is shared. The marginal claims will be the band that is potentially going to be shared with all the other districts that participate. And then the catastrophic band is everything that we ship off to our stop loss carrier, right? And so that really what we're going to have in this program is that we will have attritional and then catastrophic, anything above 125. This is an example of what it might look like if you were to looking at a claims picture where we have multiple, we call these frequency events versus well, it doesn't matter. I don't want to get too much vocabulary, but you see the bunch of them there at the bottom. Those are more of like your small slip and falls, those kind of things. Your marginal things are a little bit more expensive, and then your cat is everything above that. And you see that there's a lot less cat stuff, catastrophic stuff, than there are your frequency events, right? The severity events are the other ones. We don't want a bunch of severity, right? We want that we can handle the attritional things. And then we even have an aggregate built into this program where we have too much of any of it that protects the district. Kind of like in the fully insured program we have today. So we pay a maximum amount of premium right now, and it can never go more. It's a contractual rate. Here's your contractual rate. You divide it by 12, that's your annual, or that's your monthly funding. In self-funding, you don't necessarily have that guarantee, but we built that in. Joe and Jim will talk about that. And as a group going from fully insured to self-funding the very first year, that was something that when Dr. Bennett and I talked about this quite a bit, and the insurance committee everyone was really adamant about making sure that we have an aggregate protection built in for our first year. Down the road, if the district feels like we want to remove that, we can take a little bit of pricing off, but it isn't that expensive. Joe will talk about that. Same thing. This is the risk sharing. I just wanted that's part of it. This is an example of kind of what it's going to look like. This is us today. District D being DeSoto. We've got our attritional layer all the way to cat stop loss. So this is our 125 layer. That's the individual specific deductible, and we have our aggregate built in. And Joe will talk about that today. So this is the basic model, initial startup phase of the FSHIP program. That's kind of what it looks like. And if this were District C being Charlotte, theirs would look the same way. There is no marginal layer on the very first year of the FSHIP program.
Darren, but and we're going to handle the marginal ourselves.
Yes, sir.
In our case, that marginal goes up to 125, roughly.
There really isn't a marginal. It's really the
Just
attritional
go
goes
to that
125, and
piece,
then we send
And
it
that
off
would
the
be
cat.
different for, let's say, Okeechobee than us.
Yes.
We're not, our good health or poor health is not going to impact another district initially, or theirs with we can stand alone with this, correct?
That's correct. So this is what this slide shows. The basic model with members year one. So like there's Charlotte's, there's their ISL, there's DeSoto's with theirs. That's a little bit lower than Charlotte's perhaps. There's another member if they come in that their ISL. when I say ISL, individual stop loss, that's that individual, an individual's claims hit a certain level or peak number. Let's say someone has a $250,000 heart procedure, right? The district's gonna be on the hook for 125 of that, less the deductible that the person has or the out-of-pocket max, right? And right now, the numbers that FSHIP is projecting with different districts, the ISLs are different. Party Schools is different right now. I don't know what Charlotte's is, but 300. So to be at 125 is pretty awesome. And hopefully we can stay there, right? We don't have a bunch of hits to make it go up, but that it is the lowest of all the districts that we've presented that I've been part of. DeSoto has the lowest ISL right now. Joe can tell you why that is, and he's optimized, his software is optimized that as because of the type of claims that we have, that ISL number works better for us. Even if typically you think you raise your deductible, you get cheaper insurance, right? So that's kind of the way that works. You're transferring more risk. We're transferring more risk to the stop loss carriers, but because of the type of claims we have, it's really cheaper for us in the type. So he'll go into that. I don't want to steal his thunder. So, and he does a good job. Joe does a really good job of explaining this. It's more probably about, I don't want to mess him up and then have to come back and make me look so dumb. Because that's really what it would be, man. He does a really good job. So the risk retention layer, that's our attritional layer. That's the layer, our ISL 125 layer. The risk sharing layer will be the layer that we hopefully get to, right? That FSBIT and FSHIP say, you know what, you guys can join now. Because you looks like you've worked hard, you got a wellness program that's working hard and doing well. You're trying all of your loss control mechanisms that Avail has recommended you put in place. You're doing everything you can do to hold down your claims. One of the things that FSHIP is not going to let districts do is let people join that aren't willing to work. Right. So we don't want a district that's going to join and say, you know what, we're just joining, but we're not going to implement a wellness program. We're not going to do things that we're not going to try to engage our employees, teach them about insurance. We're not going to do the things that we know from an awareness perspective, helping them to encourage them to go for their annual physicals, the things that we're doing to try to control and help and lower our health risk. If there's a district that's not willing to do that, then they won't become part of FSHIP, or at least in the risk sharing program. So that's why that the probationary 1 to 2 years is in place, so we can build stability so that make sure that if someone does join, they're joining because they're working hard and they're earning their way in, so to say. So here's our takeaways of that says Avail, but it's not really Avail, it's the FSHIP program. This was a slide that I built a long time ago. Lowering individual district medical benefit costs by sharing medical risk. That is a hope to one day be there. Individual district plan designs. That was a huge hurdle, you guys. It was a big deal for us and the team that we put together, and Charlotte and FSHIP being able to say, you know what, let's figure out a way to do this. And let's figure out a way to help districts still stay individual, but a way to band together and control costs. And that's really what this slide says. The economy of scale opportunities, stop loss insurance, year 2, Jim will tell you a little bit about year 2, maybe, even if we don't risk share, we might still be able to take advantage if we're doing well in where when FSHIP places their stop loss insurance, we might be able to band with Charlotte perhaps. And so now we're looking at, instead of there being, what's our number? 500 employees, we're now looking at 500 plus Charlottes, which is around 1,500. So buying stop loss insurance from a 500 employee perspective versus 2,000 could help us, right? So that's an example of how just being part of FSHIP and being part of that FSBIT program can help us, even if we're not risk sharing. Loss control strategies, these guys are going to come in, help us to see things a little bit differently, help us as in Avail to help you all. The prescription benefit management is huge. That is a big, huge piece that Jim will tell you in just a second about. And then potentially ancillary coverages. So when you join FSHIP, they will have programs, and they will have, for example, FSHIP has a benefits administration software company that they use. And if that's something that this district feels like they could piggyback off, but when we join them, then we could not piggyback in the term of procurement, But because you join FSHIP, you have now access to those programs inside there. And so that's a big piece. And claim smoothing, lowering that long-term claims volatility is so, if you're a finance director or a superintendent trying to figure out your budget, this is a big piece, especially when we start getting asked, what are we looking at in a renewal? What are we looking at in a renewal? We need to know, and it's early, like right now. Well, when we're self-funding, we don't have to ask too much about what our claims are, because there are claims. We see them every month. We're paying them. So we can predict more accurately what it's looking like in a funding level piece. With that, I stop, and I'll let Jim take over, and we will, and there's time for questions at the end. Anybody have any questions to me on the fundamentals of what we're talking about? Good. All right. Thank you.
Thank you, Darren. Good evening, Madam Chair, Board, Superintendent. Thanks for having us. I'm Jim Powell with Alliant Insurance Services out of Tampa. I worked with Charlotte Schools specifically for many years, as our company has, in managing their FSHIP program. So what we're talking about, Charlotte has had actually since 2009. So they're entering their 14th year in this program, and it's worked very successfully for them. So, and we're taking our expertise that we've learned with them and rolling it out to other schools. That's why we're so excited about this, because we've seen it work with Charlotte just down the road. We wanted to give you just a quick pictorial of who all the players are, the team members, so to speak, of this program. So at the top, of course, you, the school, and then you can pick your local broker of choice as the advisor. You go through a procurement process. FSHIP proposes this program, and through that program, we are the broker. Alliant is for FSHIP, and so we go out and get the reinsurance quotes, arm wrestle with Florida Blue to get a claim paying fee. We do a lot of negotiating. You're going to hear that word a lot. That's where I come in, and Joe, and we get them to give us the best fees possible. And the idea, as Darren mentioned, is to try to minimize any transition pain by keeping Florida Blue, number one, as the carrier. Unless you don't like them, then we'll look at options. But if things are good, it's a good network, the benefits are good, we want to keep that same provider, same benefits as Darren said. So no negative impact to the employees, but we're changing the financing, which is what Darren's been talking about. So you see the other carriers as well. You know, United Healthcare, Cigna, Aetna. We've talked to all these carriers because schools around the state are using different providers currently. So we're working with all those carriers to do this same kind of approach. The other area that we're very excited about with FSHIP is the group purchasing organization for pharmacy. That's something that Alliant brokers to a lot of our clients nationally. And it's not for everybody, but there are pockets where it's really amazing. And we think it could be an amazing cost saver for DeSoto. And what that basically is a pool of 300 employers that buy pharmacy together. The pooling amount that they're spending just in pharmacy alone is $3 billion. It's the biggest group purchasing organization for pharmacy in the US. So they do every couple of years an RFP and pick a vendor who's got the best pricing and negotiate every year thereafter. And what we've seen is their pricing just keeps getting better and better. So I mentioned Charlotte Schools. When we first put in that group purchasing organization pricing in 2020, we've seen their pharmacy costs go down. The pharmacy costs never go down. They go up every year. 12% is what Joe and our financial team project without this kind of buying vehicle. So why are their costs going down? Because the price you're going to pay per script is so much lower through this big machine that's buying as a group. The rebates that come back to the plan from the manufacturers are doubled for Charlotte. Their rebates have gone from about $500,000 a year to over $900,000 a year. And that's coming back to the plan funds. So that's actually a rebate back to the plan. That's not shared with anyone. An insurance company like Florida Blue today gets all the rebates in your current structure. Their rebates generated, but they go to Florida Blue. So we're harnessing the power of those rebates and putting them back into your fund. So the savings, a lot of the savings that we're projecting is from pharmacy, believe it or not. It's really powerful. The other reason that we think this is great is control. You know, you're controlling everything. You're controlling the pharmacy, who the reinsurer is. You know, if we're using Sun Life right now as the reinsurer of choice, but they've got a lot of experience. We have a lot of business with them, but that can change from year to year. We can interchange players to have the most cost-effective approach for each school that goes into FSHIP. So it's totally flexible. OptumRx is the gray bar there is the pharmacy through the group purchasing organization. Sun Life is the reinsurer. And then if you're interested in on-site clinic, we have a lot of expertise in that. We can help with that process as well. So provide a lot of the preventive care locally, pull it out of the health plan, and sometimes that'll save money for the plan. So I just wanted you to have that pictorial of who are all these people and what do they do. Any questions about that before I turn you over to Joe?
Jim, can I say one thing? We talk about minimal impact to the employees. If we were to stay with Florida Blue and OptumRx, for example, which still is our pharmacy provider, folks that have mail orders would potentially be impacted by using CoreTrust, right? They're not using the blue mail order anymore.
No, Prime Therapeutics.
Prime wouldn't be used anymore, right?
You know, what's interesting is Florida Blue owns Prime Therapeutics.
Right. So that could be a piece of a little bit. I just wanted to throw that out there. I don't want anyone saying, you know, that nothing would change and.
Yeah, I got a good place to spend.
Right.
Yeah.
Mail order people may have to send it to a different place, but the tiers, the tiering, how much we pay for a tier 1 drug, tier 2, tier 3, that stays in this program.
We'll ask a question. I know during insurance meetings, I mentioned, hey, looks like we're gonna need to have a finance person or some kind of person expert to run this whole program with money in, money out, and how all that works. And you advise, no, we won't need that. So
Correct. That's right. Thank you, Mr. Mott. That's right. The anticipation is that finance department, how they pay bills today, when they send a monthly premium to Florida Blue, they're going to send it to FSHIP. And so all of the paying of claims, all of the
Yes.
administration from that end is being done by FSHIP. So the burden, there isn't any more of a burden than hopefully, matter of fact, hopefully it comes off a little bit by using the FSHIP program. But that's right. Yes, ma'am. So not expecting to have to staff up.
Hi, everyone. I'm Joe Logan. I'm going to go through the process that we use to do the underwriting, the projection. More helpful if I stand closer to the TV. I'm not in the waiting cameras or anything if I stand here. Am I? Is that okay?
I think that's, your screen's being shared, I believe.
Okay.
So anywhere you want to get with it.
Okay, great. Really, the question at hand when deciding between fully insured and self-funded is a trade-off of stability versus volatility, right? In fully insured world, you have a very stable cost. It's a guaranteed and set premium. It's dependent upon the way your population enrolls in plans, coverage tier, and you know what that is every month and you pay it. With self-funded, that changes a little bit, as Darren's already been mentioning, about how you're going to pay the actual claim as opposed to some guaranteed and set premium. So in looking at an underwriting process, we want to look at the population a little bit to see what kind of stability or inherent volatility there may be. So we looked at your demographics. We broke down the employees, the enrolled employees by 5-year age band and male, female gender. And we see that there's a 1-to-4 male to female ratio. So about 80% female, 20% male. The average age of the population is 48. And if you were just to Google the average age of the US labor force, you would see it's around 42, 43. So a little bit higher average age in the population can lead to a bit more volatility, right? That's not to say you will be more costly. Your chances of being more costly are a little higher than somebody who's average age. However, and just the chart in the middle really just puts a visual to the table here, right? It's just so you can kind of see the difference by age band and by age gender. However, from the way your population is composed, you're about 2/3 of the population are employees, 1/4 are children age 26 or under, that's the definition of a child, and the rest are spouses. So the bulk of your population being employees, tends to bring a little more stability into that future possible cost. And then the enrollment by tier, and this is in the way, but this larger blue section is employee only enrollment, makes up 75% of your population. And then the remaining 3 tiers are, the most of it falls under employee plus family at 14%. So the bulk of your enrollment going into employee only as well also helps to bring in a little more stability, right? So when we look at that, we see a potential for not a tremendous amount, a wide range of potential costs in the future, which is nice, right? It helps me feel more confident about the different assumptions that go into an underwriting development. So that, you know, when you give a specific result, an answer, 8 million or something, obviously the actual costs are not going to be 8 million to the penny. There's some sort of range that it's going to fall in. The more stability you see in a range or in a population, the more narrow that future range should be with confidence. On the next slide, we're going to look at the underwriting process and the various components that make up that final cost. When underwriting, you start with the actual claims. What were DeSoto County's schools claims on a per person per month basis, per employee per month basis? We looked at the most recent 36 months of claims ending January 2023. We broke them up into 3 12-month periods, boiled that down to the per employee per month cost, and then weighted, we put equal weighting on all 3 experience periods to come up with 890.97, right? So 3 years ago, your costs were a little higher. 2 years ago, your costs came down. And this most recent year, your costs have come way down. Right. And that's what I'm talking about volatility. 3 years ago, it was about 1,000 PEPM. 2 years ago, it might have been 900. And this most recent year is like 850. So that's the volatility. And part of the underwriting process is to smooth that, to say, well, you could be this high, you could be this low. We're going to take the average and start there. That's your experience claims portion of projected costs. Now, because of group size and what we call credibility, that volatility can be further smoothed out by blending your actual costs with the expected costs from a much larger data set. We call that a manual claims factor. At Alliant, we have a tool called Claros Actuarial Assistant, really great tools based on tens of millions of member lives and underlying medical claims data set, where we can feed it your demographics that we just looked at on the last page. We can feed it your plan designs, and it will spit out a number of what it thinks based on the underlying data set your per employee per month should be. And by putting some additional weight on that resulting factor, we bring further smoothing into the projected costs. Gives us a little better feel about what the outcome will be, because we've minimized some of the inherent volatility in your population's experience and smoothed it with a much larger data set, right? A fully credible data set. There is a formula that you can use to determine what this blend weight should be. And I won't bore you with it, but the result is that we would put about 63.4% weight on your own experience and the remaining 37 on the manual claims. So when you do that algebra, it comes out to 850.14. So this is what we're going to use as an estimate for your future variable costs, your claims costs, right? Because now you're paying those actual claims, not a premium, not a set and guaranteed premium. But we expect, based on very reasonable underwriting assumptions, things like trend, and later on I'll show you what those trend assumptions are. It boils down to about 7.25% annual trend inflation costs, right? Because we're projecting from that historical experience to the plan year starting this October 1st, and we're going to estimate the costs of your plan starting October 1st. For the next 12 months after that. So we think those costs are going to be on average $850 per employee per month. On top of that, we would add the fixed costs, right? Things that are set and guaranteed per month, like administrative fees, which you pay Florida Blue and F-SHIP. We estimate about $60 a month. The stop loss premium that Darren mentioned earlier, that risk transfer for the excess claims above 125,000, right? So stop loss sets a ceiling above which you will not pay the claim cost for somebody who has some sort of catastrophic event leading to costs above that dollar amount. There is a premium for that. This is a risk transfer mechanism. And based on an illustrative quote provided by Sun Life, that cost per employee per month is about $150. We've also built into the costs, the local contract effectuations, really your preferred broker's commission rate, and it's assumed to be 3% on the dot, which is, but that's the current rate now, right? So that's what you're currently paying. And when you take the variable cost of $850 and you add on the fixed costs of some of that, which I haven't done in my head, it comes out to $1,092, about another $240 of fixed costs. So for this plan year, beginning this coming October 1st, 2023, we think everybody who enrolls in the plan on average throughout that year will cost about $1,100 per employee per month. So if we have the per employee per month cost, we just need the number of employees and times 12. And we expect that we think your plan cost for this upcoming plan year will be about $6.8 million. Using your current premium rates that you pay for to Blue right now, and assuming that they give you a quasi-aggressive renewal increase of 5%. And I say quasi-aggressive because typically in the industry, you don't see the resulting increase that low. Now, you guys have had renewals that low before because you've had good experience. And this last year has been good experience. So we're giving you the benefit of the doubt. We think you might actually achieve a pretty good renewal, which would take your current year's premium, increase it by 5%, and that would be roughly $8.3 million. So you can see from the analysis for next year, we're estimating if you were in a self-funded situation next year and your claims utilization behavior continued in the same fashion that it has been historically, you would roughly save about $1.5 million, or about 18% of the projected fully insured premium for that year. So I've said a lot. Let me pause there for a second. Are there any questions before I move on? It's good news, right?
Well done.
Thank you. Thank you. I had nothing to do with it.
And
It's all you. It's your population.
I'm pretty sure this is correct, but our projected cost for next year is lower than what we're paying this year. Is that?
It is. Yeah, you're paying about 7.9 million in premium for this current year. So 6.8 a year after this year's, 1.1 million lower than what you'll pay this year. Right. And just to build on that, right? That gets into funding strategy, right? If you move to self-funded, you are your own insurance company. We become your actuarial department, right? We can talk about ways to say, well, we could arguably keep our budget rates the same. We don't have to increase them or anything and still pay for what our expected costs are. But we could also, since, in health insurance, everybody expects costs to go up, we could increase slightly just to really hedge our bets, build up that fund, the kitty, right? And then just roll that forward because now we're keeping all that money. It's not money it's not $7.9 million that you give to Florida Blue and never see. It's money you give to yourself, spend what you need and retain the rest and roll it forward. So when you go self-funded, not only do you open up the opportunity to lower your costs, but you really gain control of that funding mechanism, as well as the program itself, right? We talked about you can pick your carrier if Florida Blue is no longer the best fit for DeSoto, and it may not be. We can do an analysis to see what are the best allowed cost discounts, right? Maybe UAC has better allowed cost discounts in this county than Florida Blue does, right? And that would be the cost before your members pay out-of-pocket costs, right? Maybe if we can lower it there, then this comes down even further, right? We can do all that analysis. Most, any broker can do that analysis. We have the data to do it. We're participating in the industry carrier discount data work stream, and so that's something that we will get into, right? if you join FSHIP.
Joe, one more question.
Yeah.
The dollars for wellness, if we were to do, well, obviously we will be doing some continued wellness benefits. We would need to up the total costs per person in order to balance out the kitty, as you said, to allow for some wellness dollars to be distributed through the year. Where would that fit?
So, yes, ma'am, sort of say, right? So currently, because we're with Florida Blue gives us $150,000 in wellness funds. It's built into that premium, right? I mean, so but it's not. So when I say it's not, they'll cut us a check. We send them an invoice, DeSoto Schools does. They write us a check for $150,000 that we can use towards wellness. When we become self-funded, they're not going to provide that anymore. So we will then have to support our wellness program. So yes, ma'am, you kind of add it on to your cost, or you can count it as part of your savings. However you all choose to see it, but we will be now responsible to pay for our wellness.
So we're talking $150,000, not
So
$3 million.
that's right, that's right. Or it may even be less, it depends on what we decide to do or what the district decides to do with that.
Jim?
I'm Jim Nemchak, I'm with the FEA, and I work with 5 of the 7 counties that you have up there in the consortium. Highlands is self-insured. They use Florida Blue, and Florida Blue, you know, it's just AOS cost gives them money for wellness.
Good deal. Well, that's good as well. I can imagine it being, ASO fees are so small. I mean, compared to premium,
Right.
I can't imagine it being a lot, but they do give them some.
That makes 250,000, then 3 times the size.
Yeah, they just build it into the ASO fee, so you're kind of paying,
Yes.
you're kind of paying yourself.
Yeah, I don't think
So you can do it either way. You can have
Yeah.
a higher ASO fee and they'll get it back to you, or a lower net fee like we have here, and then you just fund it. So, but it's
Either way.
flexible either.
Yeah, I mean, either way, it's in you're paying for either in the ASO fees or you're putting off this stuff.
They'll never actually give you something for free. You're paying for it.
Really?
Here's 150, no, it's somewhere in those costs.
And just for full disclosure too, where's your clicker, Joe? I want to show the one page that Jim went over. I want to make sure that you guys see the difference. So Avail Benefits works for you, right? So that's who I'm representing tonight. Avail Benefits has a sister company called Avail Consulting. And that is the company that's working with FSHIP to develop this program. So when you see this green Avail Consulting there, that's not Avail Benefits. It's our company, but it's a different company. So I just wanted to just make sure you see that. And then when in the breakdown in the ASO fees, in the ASO medical fees, that will be the carrier. But that's also there's a portion of that goes to FSHIP for the administration. And there's a portion of that goes to Avail Consulting too. So it's built in there. And so just full disclosure where all those fees are, who's going to what. There's not an expectation of any extra ones. The local contract effectuation, that's Accentria, your local broker. That's them. That's that. That is the servicing of this contract. The two employees they have that helps members with claims. That's their nurse for wellness. That's all built into that. Their assumed 3.0% broker commission is what they have today, right? So that's in their contract, and we're looking to. They know this. We're going to talk with them, representing you all, the board, to renegotiate that contract this year. So that number could change, is what I'm saying. It may go up, may go down. It depends on how well they negotiate with Dr. Ben, right? How much he squeezes on.
But I'm gonna squeeze them as much.
I know you are. Thank you, Joe. Hopefully, won't watch. No.
Any other questions? Okay, we can move forward. And here on the next slide, we're going to talk a little bit about the risk transfer, right? We talked a little bit about ISL, individual stop loss. In this analysis, the assumption is 125,000. Any individual, all members, not just employees, anybody covered under the plan, you will not pay more than 125,000 of their claims. You will pay a premium to whatever reinsurance carrier ends up giving us the best quote for this risk transfer. We've been working with Sun Life, that's who provided these illustrative costs. So that is on the individual side. There's another form of stop loss called aggregate stop loss. which is more about the group as a whole. What it does is effectively look at your expected costs. Sun Life has their own underwriters that get the same data that I got. They're going to do their own projection and assumptions. They'll come up with what they think is your expected costs. They probably won't get much different than what I've got, about 6.8 million. And on top of those, well, the claims costs, I should say, projected claims costs, they'll add a 25% load. They'll say, for this aggregate policy, the group is only going to be expected to pay up to 25% more than their expected cost. Above that 25%, we will pay the costs for the group as a whole. Now, there's a number of different characteristics or things that go into that 25%, right? All of the stop loss claims, for example, the people with a greater than 125,000, those claims above 125 don't get counted into what's applicable to the aggregate policy, right? So there's a number of contractual things. They're very boilerplate. They're very common, right? They're going to be the same from any reinsurer for their aggregate policy.
Okay, now I want you to do this in slow and simple because I'm pretty country.
Okay.
Well, everything you've said, does that mean 7,561,000 is the most we pay? Regardless of whether it's $125,000, $50,000, or is that the fixed cost, everything?
There's a little bit of nuance, but generally the answer to your question is yes. If your ISL is 125, your aggregate policy would be maxed at 7.6 million, right? You would not pay more than 7.6 million in the self-funded policy. Now, in the reinsurance world, this has an impact on this. Okay, so if to the degree this can change, this can change.
Now that's what I need some explanation,
Okay,
a little more detail.
so at the individual level, you're going to pay up to the ISL, that 125 in this case, right? And there's an expected number of people in a group of 1,000 members that should have that high of a claim, right? There's a profile for incidents at different thresholds. And ultimately, your total costs, does this zoom in when I tap? Okay, that's pretty cool.
Smart technology.
Need one of these for home. Yeah, I know. Where's I go? Technology must be.
The lower the specific, the lower the aggregate, the higher the specific, the higher the aggregate.
Thank you, thank you. So you have expected incidents of claimants at different thresholds, right? And if your population fits that profile, your actual cost will be your expected costs. If you have an unfortunate year and there are more people than expected who have the higher costs, that's what makes your actual costs higher than expected. And that's where aggregate policies come into play. But if your ISL is higher, then your expected costs are higher because you're expected to pay more of the cost per claimant. So 25% higher than your expected is going to be larger when the ISL is larger. Does that make sense?
It does.
Okay, great. Okay.
It does. So what we're saying with 25% cushion, we're pretty doggone safe.
Yes, and let me go on to say that from a statistical standpoint, to have costs at 25% more than expected, you're talking about like black swan events, right? We're talking about the very far side tail of a bell curve, right? Because variable costs are a bell curve, and underwriting gets you right at the middle of the bell, right? So to have 25% higher than expected is like the 99th percentile of the range of possible outcomes. So you're talking about 1 in 100 years,
Does that,
not actually, but sorry, go ahead.
I'm sorry, does
No.
that take effect on year one or after our grace period?
The aggregate policy takes effect in year one. It's part of the stop loss contract that we negotiate for year one of self-funded.
And again, we would be paying more than that, I think we're paying more than that right now.
Paying 7.9.
Yes.
Right now, because every month I go to the bank statement, we're putting on $600,000 in their cost this year.
That's right. Yes, sir. And Joe, reference how, and from a cost perspective of the aggregate compared to ISL.
Yes. The premium we assumed here, about $150. $5, $6, $7 of that is your aggregate policy, right? We call aggregate policy the sleep at night insurance because barely no one ever has a claim on the aggregate policy. It's, single digit, $5 PEPM amounts to $50,000 to $70,000 of premium every year. And I mean, in the scope of $7 million, you're talking about 1% of your total cost goes to the aggregate policy. You could pay it or not pay it. You're most likely not going to need it, but it helps you sleep at night if you have it,
It's
right?
like having a hole-in-one policy in a golf tournament.
Right, exactly.
Exactly.
Yeah.
The chances of it occurring are very minimal, right?
So that's aggregate stop loss, right? And for that roughly 75,000, whatever it is, you sort of lock in this ceiling of about $7.6 million that you would pay in a self-funded situation for next plan year. So that's the discussion around your maximum potential costs in self-funding right now. Now, I will caveat, this is illustrative. So when the time comes to really pull the trigger, we will speak to Sun Life. We'll get a formal quote. The numbers won't be too different. In fact, because your most recent 12 months experience has been better, it's possible that the quote could come down. I don't want to make any promises because they are going to add their own trend, right? They have to see trend in the industry. So just because your numbers come down doesn't mean that the industry expectation of cost is going down. But this number should be about the same when we get to the actual quoting with Sun Life for individual and aggregate stop loss. Any questions about this? Any other questions? Okay, the last thing for us to consider is the sort of 5-year pro forma. If we held a lot of assumptions constant from year to year to year, and both on the self-funded version as well as the fully insured scenario, then just to skip to the punchline, you could be saving around $10 million over 5 years, right? There's a lot of compounding effects that go in annually here, right? We're assuming that your claims experience would increase at the sort of industry inflation level of about 7.25, right? Behind that 7.25 is actually medical inflation and pharmacy inflation. Darren mentioned pharmacy is at 12, right? Medical is more around 4 or 5%. So that blended average comes out to 7.25. And I meant, it's great that Darren mentioned pharmacy is increasing at 12% on an inflation basis, because we haven't even touched on how CoreTrust, the GPO, the group purchasing organization, would generate is largely responsible for the savings in this 10 million. We will get to there. Part of the other assumptions are that your ASO fees with Florida Blue or whoever the carrier is would increase at 3%. Now, they don't always increase 3% every year. Sometimes you go into a 3-year guarantee and you lock in what those rates will be, and there may be some kind of contractual escalator or something like that. But in the industry, a default assumption about what fixed costs increase at is about 3%, give or take. Your stop loss premiums, we do assume they would increase 20% every year. And stop loss contracts are a single annual year contract. You go to the market and you look and see what the carriers are offering in the market. Some carriers have bad years. They don't give anybody a good deal. Some carriers have great years and they're looking to buy business, and you can capitalize on that, right? You can get your stop loss insurance by switching carriers and seeing an effective 4, 5, 6, 10% increase, which is very low, because generally for something called leverage trend, the reason is called leverage trend, the stop loss premium market increases at 20% every year. This is a default assumption, and it could be worse, and sometimes we're able to negotiate it to be better. that's the assumption for the 5 years, right? Some years may be higher, some years may be lower, should average out to about 20. We also assumed that the Accentria's commissions would remain at 3% through the 5 years. For the fully insured comparison, right, we gave you the benefit of the doubt of your first year renewal being 5% because of how well your experience has run the last 12 months. But then thereafter, years 2 through 5, we would assume 10% increase, which is also on the slightly aggressive side, right? I mean, as I mentioned, the stop loss carriers, medical and pharmacy carriers, they have good and bad years, and sometimes some other organizations' bad experience is going to impact the minimum that a carrier can go for your renewal, right? So a lot of times you'll see them start off high, 20, 30, 40%, especially if your experience is bad. And we try to negotiate that as low as possible. I think in your experience, you've negotiated 0%, right? Yeah, a couple times. So that has borne out really well for you, but that's not always the case, right? And so it's not that you can say that will be the case for the next 5 years. So as far as the market is concerned, the 10% increase is not bad, right? We might assume something like 15 or 20% as a general starting point. So first year fully insured renewal 5, 10% thereafter, right? All those things go into play, and we have a projected 5-year self-funded costs of about $40.1 million and 5-year projected fully insured costs of about $51 million. So savings over that time period, $10.7 million, about 21% of that fully insured cost. Any questions about that?
Madam Chair, one of the things that Avail Benefits would recommend as your employee benefits consultant is that, especially in any of our groups that we're seeing such aggressive savings in that first year, and then when you trend this out and look at 5 years, we would be recommending, if we were to go down this road, that you guys we would think of like a rate hold for 2 or 3 years, right? So instead of trying to aggressively take those savings and place them somewhere else, we would want you to think about taking those savings and really building your kitty or building the reserve in that fund is what we would recommend.
I would think Dr. Jim Check and the union folks would agree after we went out to bid and our insurance went up and we bid it out. And if we could just, it would be a prayer answer, I believe, if we just stayed level. And, and not get an increase.
Right.
And I think all parties would agree that we want to protect the insurance fund. Because, you don't retire on your insurance fund.
That's right.
When it's time for these teachers to get the top end, it's those salaries.
Well, and Dr. Bennett, several years ago, when Joe mentioned we were able to successfully negotiate a couple of flat renewals. And I think Coach Mead, Mr. Mead would probably agree that at that time, we actually tried to encourage to take a rate increase those couple of years, but salaries were very important. And so the district did what it needed to do and took those rate holds and used those savings maybe towards salary. Well, we weren't building our reserve, right? So then that big year hit. And so which that volatility we're talking about. So we were approached with, 15% rate increase, which had we been kind of building firewood every year, maybe taking a 3 or 4% rate increase, that wouldn't have been so tough. So that's what we're saying. It's going to be tempting to see those savings and go, man, we could use that somewhere else. We're recommending that you keep funding at this level that you're funding right now. Or if you do go in this program for at least 2 to 3 years, then you can start looking at how big your reserve would be in that ship. And we can have that conversation with these guys. But anyway, I thought that'd be a good place to
I appreciate that.
to tell you.
That's gonna be very meaningful to when we looked at the demographic of the ages of our staff. That's gonna be very, very important to them.
So that's a lot of savings. You're saying that's too good to be true, right? Where did these savings come from? When you make the switch from fully insured to self-funded, there are a number of taxes that come out of that premium cost, right? The premium cost is built up similarly to what we looked at 2 slides ago. Your expected costs, the blend with the manual, the cost to run an insurance company, which they call retention. And part of the premium is an explicit line item for profit. They'll usually include 2 or 3% profit in that premium that they're actually charging, right? Part of the retention is also things like health insurers tax, which is a tax that is part of the ACA bill. PCORI fees are another fee that's charged on a percentage basis, and a couple other state taxes and things like that that are just all part of legislative blanking the word, just requirements that are part of that premium for an insurance company to run their insurance in the state. So those taxes all come out, right? And now you're just paying those taxes can amount to roughly 5% of 100% of your premium costs, right? On top of that, we talked a little bit about CoreTrust GPO through Optum. There are two sort of mechanisms through which a GPO can achieve lower costs. They can negotiate lower ingredient costs directly with drug manufacturers. They can get those costs down. So drug manufacturers sell bulk. They sell their drugs bulk on an average wholesale price discount, AWP discount. And the more purchasing power a group can go to manufacturers and say, we're going to spend billions of dollars with you. Give me the best price you possibly can. That's what increases that AWP discount so that the actual cost of the drug at the manufacturer to GPO level, that distribution channel, is as low as possible. Beyond that, there's the rebating that Darren mentioned, where, in Charlotte County's example, they saw their rebates double, right? It's a per script rebate, where for brand preferred, brand non-preferred, and specialty, there is a fixed amount, something like $300 or $400, $1,200 that's negotiated between manufacturers and the GPO. And again, purchasing power speaks volumes when they go to these manufacturers and say, you're going to increase your specialty or brand non-preferred tier by so much because we've just added all these other groups to our group purchasing organization. So your ability to sell more drugs is going to increase. So give us a better rebate. You still make more money in the end if you increase this rebate because we'll come to you buy our drugs. And typically the integrated pharmacy houses, right? We mentioned Prime Therapeutics, which Florida Blue owns. That's a profit center for them. So they have not a huge incentive to negotiate higher rebates on your behalf. The rebates are what the manufacturer gives them, and they pocket all of that, especially when you're fully insured. You get none of those rebates, right? Through CoreTrust, you would see CoreTrust's level of rebates, the per script rebates that are negotiated, and those would come back to you literally in the form of a check. It does come back on a bit of a lagged basis because there's a timing difference between when scripts are filled, the process of collecting the total amount of scripts filled in a time period, processing those from Optum to CoreTrust to manufacturer, back to Optum, back to CoreTrust, back to you. So there's about a 6-month lag process there. But depending on how you do your financing, your accounting on an accrual basis, you can take an estimated rebate amount and consider that as accrued, right? Or part of the present bottom line costs to your program, right? And part of the contract is usually to establish a minimum rebate guarantee. And a lot of times actual rebates exceed the minimum rebate guarantee. That minimum rebate guarantee will be calculated based on what they're able to negotiate with the manufacturers. So you're getting a tremendous savings value from using these GPOs. And so those are the mechanisms that are generating this 10.7 million in savings over 5 years. Beyond that, right, there's opportunity to generate more savings after year 1, year 2, when we enter into the, I'm just going to call it a captive, right, where you sort of spread that risk in the marginal level across multiple school organizations, right? Basically the way that will work is somebody will do some calculations, they'll come up with what the expected cost is in that level, everybody will pay into it, and if you have a better than expected experience, there's dividend refunds, which will generate more savings, right? But it is a risk transfer, so if you have a good year and somebody has a bad year, then the part you pay helps to pay for their unfortunate experience, but that also comes back to you if you have a bad year and somebody else has a good year, right? So that's risk transfer, but there is the opportunity for more savings there, right? So this 10.7 can always be a little higher for years 3, 4, 5, right? If we get to that point. So that's my spiel for this. Any questions about the 5-year look?
So regarding pharmacy, I get the kickback thing and I get that having the buying power of having so much in warehouse, whatever. So then the question, maybe because Charlotte County has been using this as well. So we're using what on Florida Blue plan for prescription plan and whatnot. Let's say someone is spending $100 a month on prescriptions right now. Do you have numbers that would tell us maybe what someone's general output would be, how it might differ based on, like, currently they're spending $100 on prescriptions going out, and if we were to go to this, what would it maybe look like for them spending going out for prescriptions in this kind of setup?
So, you want me to try?
Does that make sense?
Well,
What I'm
let
asking?
me say, so, a member's out-of-pocket costs is gonna be based on your plans.
Right.
So whatever you say the copay is for that person is what the person will pay for their copay. The remainder after what they pay is part of the savings that the GPO can negotiate, right? So, and if you're self-funded, you control your plan, right? If you wanted to, you could take some of the estimated savings and reduce copays a little bit. I'm not suggesting big perturbations to your plan design initially, right? Again, this is all about stability versus volatility. You don't want to introduce a lot of things to bring more volatility to the program, right? So holding your plan design stable, building up your reserves, and looking for opportunities to relieve some of that cost pressure at the population level is something you may want to think about after year 1, right? And you could,
If we changed one to United Healthcare
Mhm.
and we were fully insured, there would be a change in prescription.
you would have to choose one.
Somebody might have a prescription that they're not paying very much for with Blue Cross Blue Shield, they might have an increase. I think that's just a risk that's inherent with prescription plans, but overall, we should see a lower or at least a stable
From the
cost.
district's perspective,
Right.
right?
There's gonna be an individual that could see a higher.
Well, if, let's say, I mean, we're not expecting to go to United, right? So we're expected to stay with the Blues. But that's just on the medical claims. On the pharmacy side, we're expected, if we join this, to go with CoreTrust.
Mhm.
So, but to your question, Ms. Mott, if a member's paying $100 today, most likely they're gonna pay $100 tomorrow. Because they're paying $100 because that's their co-share. I mean, their co-insurance, their copay for those drugs. And so they've got 3 tier 1 drugs, and those are $15 a piece. Right, and then they've got a specialty drug that's this much, and it adds up to $100. Well, that's the risk that they hold. That's their risk retention on the pharmacy. So when we join, they're still going to hold that. So there really isn't an expected savings there. The expected savings will come to the district. So because that drug that is now, they're paying $15 for, right now, the district is paying maybe $450 for. But when we go to FSHIP, that the district will be paying $150 for this. See what I'm
And
saying?
that answers it because we are able to make those definitions of what their copays would be.
Oh.
And there's potential for future after we feel a little bit comfortable with some
That's right.
padding,
That's
that we could reduce some of that to help.
That's right. I mean, even deductibles. I mean, there, any of that plan design, what looks to be a good risk management decision, we would want to look at those.
And in self-funded version, you have the control over what that plan design looks like, right? And fully insured, you sort of have to pick from the basket what carriers offer, right? So that's it. Well, this kind of looks like what I want, so we'll take that. And they say, well, this costs that much. But in self-funded, right? The plan design changes you want to make we have the ability to model and say you did want to decrease the pharmacy copay. The remaining cost would go to the district, right? This number would come up slightly. If you were going to lower, because a $50 drug, the member pays $15, you're paying $35, right? If that drug is still $50, but the member pays 10, you pay 40. That additional $5 accumulates and so it brings it up. But with Core Trust, that 50 might be 45. So you can take the 15 to 10 and your cost is the same, right? So all of that kind of analysis can be done when you're self-funded. We have the tools to look at it and do all the modeling, be part of benefit strategy going forward.
Mr. Judge.
And another county member asked the question, how come Highlands employees can get diabetes drugs free? Because in the plan there, the school board has decided to cover 100% of diabetes drugs and nothing to the copay. But nothing to do with the manufacturer, but same thing we could do here. They just say, if somebody's diabetes, we want them on their med, we're gonna pay for 100%.
And Jim, correct me if I'm wrong, Highlands so often that they've got something that requires going to the doctor, they're having to go to Winter Haven.
They don't have to.
But
There's
that's their,
an incentive.
that they do that with a cost card or something.
Yeah, like colonoscopy at Advent Health is $6,000. They can go to Winter Haven, get a colonoscopy for $1,600, and they get a $250 gas card. The district still saves $4,000 in every colonoscopy. Those are the outside contracts you can do with providers as well.
Right. And that's something we'll have that same access with our
Absolutely.
hospital or Sarasota
Right.
for a heart procedure or
That's
whatever.
right. That's right. Yes, sir. And that's kind of how they came about that. I was just looking at, because they're self-funded, they were looking at claims being paid to Advent. And so they talked to Florida Blue set up a special network, sidecar network for them in Winter Haven. And so are we about to a place where we can summarize? And so to summarize, you guys, we've gone through a lot, right? And so a ton of numbers and lots of things, but I think the biggest takeaways that I would want you all to remember as if you want to move forward in this process, and we are at a place where at some point in time soon that we need the board to decide that we want to move forward. We've gone through insurance committees. Insurance committees made a recommendation, superintendent, for you guys to keep moving forward. We're at a place, FSHIP's at a place, Alliance at a place where soon, and when I say soon, in the next month or so, we need to decide from an employee, from a bail benefit side, for this board, are we staying fully insured? Or are we moving? Because there's lots of setup that needs to go, even though we're staying the same carrier, there's things on the back end that we have to get moving for. So, but to summarize, there's opportunity for savings, right? That we now own our claims, that profit that we've been paying Florida Blue can stay with us. One thing that I hit on really quick that I think is important and is that application into the FSHIP program, if we were to get into the risk sharing, the captive model, which I hope that's where we end up being, that contract effectuation piece by somebody has to be done. You won't be able to get into the FSHIP program if we don't have that service. It's going to be a requirement for everyone who joins that, is that there's got to be someone on their end doing that contract effectuation. That's your wellness, that's helping the members with service, that's an indication. If there's a district that tries to join that's saying, you know what, we're not going to have that, they probably won't be part of the risk sharing program. So I don't want you, while that looked like a pretty big PEPM at $32 per employee per month, I don't see us joining FSHIP without having that, not that number, not that price, but there's got to be a contract effectuation by someone, either the district. And right now, or it's got to be done by either the district or you're paying a local broker to do that.
And we can't do it as a district.
That's right. That's
By the
right. So
time
those,
by the time we throw all the benefits, retirement, et cetera.
that's right. Yes, sir.
It's 3%. I don't think you need to advocate further. I think you probably understand.
Yeah, well, right. Some people may say, well, I mean, but because it's something that I think it's important. In some cases, a district, for example, Highlands, the reason why I mentioned that, Highlands doesn't have that. That would be something that if they were to join FSHIP and then they would want to eventually get into the risk sharing program, that they probably would have to ramp up, is my point. Is that, and because I don't think they have, I think they have one person that kind of helps with claims and stuff right now. That's it. They don't have an in-depth wellness program like you're hitting right now, using a registered nurse to build that and those kind of things. So that's important as we move forward. And so Hardy Schools is talking with that ship right now, and Hendry are the three HEX schools that are really kind of hot right now. So just to let you guys know that. With that, I think we're finished unless you guys have more questions.
Well, I think I would like to, I'd like to put this on the agenda for a month from now, the first meeting in April. That would give us a month to.
That's good.
Yes.
Then real quick, as we go forward with that thing, really, there's not a provider other than y'all for this.
Dr. Bennett, as far as we
I
know,
mean,
we're the
I'm-
only ones doing it like this.
So correct me if I'm wrong, aren't the other districts looking at y'all being a sole provider? Rather than
It's
having
been
an
mentioned,
extensive RFP?
Yes, sir. I mean, it's. That's. Your council would be able to help you with that. We certainly can't tell you that that's the way it is, but we know of no one doing these things.
Sarah, can you look into that piece for us?
Yeah, well, here, you can look at a sole source, but you also have the option to waive it in the best interest, and I think, there's certain factors, right, in terms of just knowledge of the district and stuff, so there's plenty of factors, so as a board, you could waive the competitive bidding. If you wanted to proceed with a solicitation, you're talking about adding probably close to 6 months to the process in terms of drafting it, going out and requesting it,
If
so.
we could wait, and I think that'd be those things, the board we want to discuss, we want to waive that piece and be able to move forward, because we're cutting it close, getting October
Yeah, I mean, so, right.
1.
Typically, when you're looking for a broker, that's already going out for those services, that's already out. You're kind of, this is about the time you're locking down those contracts and they're starting for you. And really, it should happen kind of in January where you get your new broker. So you are late, absolutely. So I would recommend it as the attorney, kind of knowing that to start that process now. So you can look at the options and stuff, but competitive, waiving the competitive bidding is absolutely an option.
Is that required by the board?
Yeah.
Yeah. So
It's a vote, you're selecting the vendor, so you're waiving the competitive bidding in the best interest of the district and selecting this individual. And then you could also, you could give direction to just staff, like look and see if there's other vendors that provide this, they can, My Florida Marketplace, there are some areas where you can look to see. But with certain things, you want familiarity with kind of the district, the area, the providers, so those are some things that do play into it. So it's not an apples to apples. If they were to say, find somebody that does it near Jacksonville, that may not really work that well for the district, at least initially. So-
And I think we would lose the potential of that future middle piece that really y'all are going to be the only provider for that I'm aware of, is having that opportunity.
All right, well, thank you much
Thank
for
you
your
all. Thank
presentation.
you.
It was very well done. Everyone was so knowledgeable of all of that. Dr. Bennett, do you have anything additional?
Just hope everybody enjoys spring break next week.
Yes, for sure. All right, with that, I'll take a motion for adjournment. All right, thank you, 6:28 PM. And we are officially adjourned. Thank you so much.